Welcome back to Explain the Charts. Today is October 6th, 2025, and we are taking a deep dive into Ethereum, symbol ETHUSD. We'll start with the latest breaking news and events driving the market, and then transition into a full technical analysis across multiple timeframes. The news today is overwhelmingly positive, with headlines buzzing about Ethereum reaching the $4,600 milestone and price predictions eyeing even higher targets. This momentum is reportedly being fueled by rising expectations of interest rate cuts, which generally makes risk assets like crypto more attractive. We're also seeing a massive surge in institutional interest, which is a key theme for late 2025. Major players like Swift have been confirmed to be using Linea, an Ethereum layer 2, for a crypto payments ledger. Furthermore, the Walmart-backed OnePay is planning to add Ether trading and custody, signaling significant retail and corporate adoption. This isn't just speculation. Corporate treasuries are actively investing, with firms like BitMine emerging as massive holders of ETH. On the development front, anticipation is building for the upcoming Fusaka upgrade, which aims to dramatically improve scalability and lower fees, a potential game-changer for the network. However, it hasn't all been a straight line up. The market is still processing recent volatility. Just a couple of weeks ago, news outlets were reporting heavy liquidations and ETF outflows that pushed ETH below the psychologically important $4,000 level for the first time since August. Whale activity has been significant, with reports of large wallets accumulating over $1.7 billion worth of Ether during the late September dip. This mix of strong fundamental developments, increasing institutional adoption, and recent volatile price action sets a fascinating stage for our chart analysis. Now, let's pull up the full daily chart for ETHUSD to get the big picture context. Looking back over the past year, we can see a very volatile but undeniable long-term uptrend. The price established a major bottom back in March and April of this year, finding strong support in the $1,400 to $1,500 range before beginning its ascent. We saw an absolutely explosive move in August, where the price surged from around $2,300 to a peak near $4,900 in a matter of weeks. That high, established on August 22nd, remains our key long-term resistance level to watch. Following that peak, we entered a necessary corrective phase through September. This is where the news of ETF outflows and market-wide liquidations really took hold, as we can see with this sharp drop on September 25th, where the price wicked down to a low of $3,825. Crucially, buyers stepped in with immense force at that level, establishing a new, powerful support zone between $3,800 and $3,900. The ability to hold this level was a very bullish signal for the market. Since that low, the price has been in a strong recovery mode, breaking back above the $4,000 psychological barrier and climbing steadily. This powerful recovery rally directly correlates with the recent positive news flow regarding institutional adoption and favorable macroeconomic sentiment we just discussed. We are now challenging the highs of the year, showing incredible resilience. Let's zoom in our daily chart to focus on the price action since the beginning of September. Here you can see that sharp sell-off to the $3,825 low on September 25th much more clearly. Notice the long lower wick on that candle, indicating a rapid rejection of lower prices and strong buying pressure. The rally that followed has been methodical, reclaiming key levels one by one. First, it took back $4,000, then it broke through the minor resistance around $4,200. Now, we are consolidating just under the $4,600 level, which was the high of yesterday's candle. That candle from October 5th shows a high of $4,619, but a close of $4,514, which suggests some traders are taking profits at these new highs, creating short-term resistance. The volume during this recent leg up from below $4,000 has been consistent, but not climactic. This suggests the rally is healthy and controlled, rather than a speculative blow-off top, which is a constructive sign for bulls. Switching over to the 1-hour chart, we can get a much clearer view of the short-term trend and immediate key levels. Over the past 3 days, the price has been trading within a well-defined ascending channel. This pattern of higher highs and higher lows is the textbook definition of a healthy short-term uptrend. The upper boundary of this channel corresponds with the recent highs around $4,620, which is now our immediate resistance. On the downside, the lower boundary of the channel is providing dynamic support, which currently sits right around the $4,500 psychological level. This makes the $4,500 mark a critical level to hold for the short-term bull trend to remain intact. If we were to break below this channel support, the next area of interest for buyers would likely be around the $4,430 zone, which acted as a consolidation point before the last move up. For those trading on even shorter time frames, let's drill down to the 15-minute chart to see the intraday action. Over the last several hours, we can see the price action has tightened significantly. We are currently in a sideways consolidation, or a tight range, between roughly $4,500 on the low end and $4,530 on the high end. This type of price compression often precedes a period of expansion or a more volatile move. Volume has been decreasing during this range, which confirms the market is pausing and building energy for its next leg. A sustained breakout above the $4,535 level would be a bullish signal for intraday traders, likely targeting a quick retest of the $4,580 to $4,600 resistance zone. Conversely, a breakdown below the $4,500 support would be a bearish signal, opening the door for a drop towards the hourly channel support near $4,480. Okay. Let's bring it all together by going back to the daily chart for a final recap and outlook. To summarize the key price levels, our most significant long-term resistance is the August all-time high area around $4,800 to $4,900. The immediate, short-term resistance to break is the recent high near $4,620. On the support side, we have a minor level at $4,500, followed by a more significant zone at $4,400. Below that, the major support levels are the psychological $4,000 mark and, most critically, the September low around $3,800. Now, for our unbiased predictions. The bullish scenario, which I would assign a 70% probability to, is that the current positive momentum continues. This is supported by the strong fundamental news and the powerful technical bounce from the September lows. If ETH can hold above $4,500, a test of the $4,800 all-time high seems very likely in the coming days or weeks. A clean break and close above $4,620 would be the key condition to reinforce this bullish outlook. The bearish scenario, with a 30% probability, would involve a failure to hold the current uptrend. If we see a decisive break below the $4,400 support level on the daily chart, it would suggest this rally has run out of steam. This scenario would be reinforced by a sudden turn in broader market sentiment or negative regulatory news. A break below $4,000 would shift the entire market structure to bearish in the short to medium term. Looking ahead, keep a close eye on any news related to the Fusaka upgrade and institutional flows. Also, monitor the volume on the next significant price move. High volume on a breakout is a sign of confirmation, while low volume could indicate a trap. That's our analysis for ETHUSD today on Explain the Charts. If you found this video helpful, please show your support by hitting the like button, subscribing to the channel, and ringing the notification bell. And now for the disclaimer. Please remember that this content is for informational and educational purposes only and should not be considered financial advice. Cryptocurrency trading involves a high degree of risk, and you should always conduct your own thorough research before making any investment decisions. Thanks for watching, and we'll see you in the next video.